Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Good day, traders. A short video on trading the London session today. I'm going to keep hammering home the basic concepts from the playbook, and hopefully traders through repetition will grasp, the ones that are struggling will grasp the concepts. And so the first thing, coming back to having a thesis or identifying pairs or instruments on the day that potentially will offer traders an opportunity. So coming back to understanding what markets are in breakouts, if we're the day count, all of those things. Simplicity is paramount. So number one, we talked about Japanese yen. Day one was our Thursday as it broke out the high of the week, and then that breakout failed. It failed not only at the high of the week, but it also failed at the high of the previous day heading into Friday. And therefore, Friday's break of Thursday's low triggered day one shorts into the market. And then Monday, the beginning of our new week, we went through that yesterday, that triggered day two shorts into the market. That market closed back inside, or what Dalton would call, I think, back in balance. So a market that is out of balance is when it closes outside of the range and stays as a breakout market, which allowed us to form a thesis heading into the Asian session. That also gave us a thesis in the London session based on the Asian trade, and also a high of the day opportunity in the US session for an easy 25 pip blow off. But you'll notice that market closed back inside of Friday's range, Friday's closing price. So that market was back in balance. If I was to trade a market like that, which again, I'm looking for opportunities in markets that are potentially out of balance, or they go out of balance in the timing window, meaning they break out. But the only thing that I can do if I'm going to trade that market is identify my high and low consolidation. We already have a market that the bias is on the downside, so potentially we want to either be working from the extremes when the timing window of our session starts, whether that's Asia, London, or New York. In this particular case, we have a market that opens down low and breaks the low in the London window. When it breaks that area, that is when I go to my universal entry criteria. This is not what I'm going to say as a best trade setup, but in the light of trading this pair when it is back in balance, I still need to go to my high and low of the day and then my 5-minute universal entry criteria from the playbook. Remember, on page 25, false breaks can be the beginning of large moves. Now, if traders were to have taken this trade based on the universal entry criteria, which is, again, even a later fill, not to suggest this is a best trade setup, but this market has generated an easy 25 pips in the London session for traders who bought the low of that market on a breakout reversal. Coming back to identifying the best pairs to trade on the day, this market was in balance. So potentially if traders were looking for that reversal on, we had a day one, day two, day three, that potentially was not a first green day, but maybe traders had an opportunity of a market that is breaking down for that beginning of a reversal trade. No idea, but that criteria was met on a market that was in balance on the day. When we come to our Swiss franc, we have a market that had, from the beginning of our high of the week, day one count, up at the high of Thursday, a market that failed. We had day one shorts in the market on Friday's close, which we talked about again yesterday. We'll just highlight this. Day one shorts. The market broke out on news yesterday and remained broken out. Day two shorts, as some traders messaged and noticed this opportunity. And if we come back to the playbook, on page 6, we talk about trigger days, day 3 longs, day 3 shorts, potential reversal opportunities on page 6. We have our day 2 breakouts in the market, and traders are trying to sell down or buy the low when it breaks the low, But again, their universal entry criteria are not met, and it's about what happens in the timing window itself. Day 3 breakouts are in the market, and our universal entry criteria is met in the London window, heading back right 5 minutes into the London session, and that market is currently up approximately 25 to 35 pips and still on the front side of this move now. So coming back to our thesis, day 2 shorts in the market, it breaks out and triggers our day 3 shorts. We get our dump and pump reversal on day 3 with our universal 5-minute entry criteria met. Now this is an interesting pair, but I want to reinforce some concepts. Traders are calling all kinds of reversal days or trend days as first green days, first red days. When you see a first green day or first red day, I want you to think about what's happening here. We have a market that came down from the high of the week on Wednesday on the Canadian dollar, day 1, day 2, day 3, reversal with volume trapped at the low of the week, which closed above the opening price. We have volume trapped above the opening price at the low of the week. Just highlight this. And again, that gives us a close above the open, which is our first green day. First green day is a low of the day, a low of the session, buy low opportunity if it presents. So again, we go to our 5-minute entry criteria. When we are trading the session, if we have a trigger day or a potential trigger day, it's about the timing window. The timing window that we have laid out in the playbook. And our universal entry criteria was met on that day, which gave an easy 25 pips. But carrying that forward into the new day, if our thesis was that Friday was a first green day, we had an inside bar yesterday. And so the inside bar, we have 2 types of inside bar trades. We have trend trades and we have reversal trades. But if we have a first green day and our inside bar was actually a buy low opportunity that gave an entry and that was still intact, our thesis therefore would be buying low in the existing trend if you were trading this pair. Now again, I'm not suggesting that trying to trade one pair every single day is the best opportunity. I look for the pair that signals the best trade setup on the day that I'm trading. But this first green day trade is still continuing. Now, again, our universal entry criteria has been met on the day for a buy signal. And you'll notice again, when you're buying low, we get the dump and pump, the higher high, the higher low for the continuation trade on day 3 now, headed back possibly towards the high of the week. I'm only laying out the foundations, which are clearly defined. So traders are struggling, but you have to step back and look at, number 1, do I have a signal on the day? Now, I've just laid out the Japanese yen and Canadian dollar were pairs that I would not have looked at if I was trading London. And the reason why is because, as I said, we had a Swiss franc, which is obviously possibly going to move in the European London session. But we had a day 3 breakout. Day 3 breakout, which that criteria was met strictly from the playbook. And now if we look at the other pairs, euro and pound, we had a market that broke out right at the open of the London window. That is a trigger. We had essentially, for all intents and purposes, we had an inside bar yesterday. The inside bar opportunity, if it presents, could potentially be a false break trend trade or a low-hanging fruit opportunity. The low-hanging fruit is when the market is already reversed or continuing and there may be an existing re-entry in the next session. But coming back to our criteria, the false break, our universal entry criteria was met right at the high of the day, the high of the week, and that trade has generated over 50 pips. Again, these are right out of the playbook. But so traders are trading this, we're inside. But when the market breaks out, coming back to a video that I keep repeating the phrase, most breakouts fail. My mentor, Bill McLaren, taught me this. But if you're trading this, you're getting caught in the breakout. You're getting caught in chasing the momentum and the price on the day. Do you notice there's no news scheduled for the British pound or anything, but it goes vertical and breaks out. That triggers breakout traders into the market. But we have our reversal, our false break, and the market collapses. These higher lows are a dead giveaway. They're trapped, and the market has continued to fall from the high of day to the low of day. Again, the trigger on the day is the inside day. We look at the euro. We have a market that closed in breakout. Day one longs in the market. We closed out of balance. So that means we closed outside of the previous day's range. We have a high and a low opportunity. The market does not breach the high of the day when we get into our London timing window. But what do we get? We get a break in structure, the higher lows, and then the breakdown before the window starts. It breaks down and makes a lower low heading into the Europe-London Open. Lower low, up high is the setup for the pump and dump. We have a market that closed in breakout, that's out of balance, and it gave traders the universal entry criteria in the London Open window. That market is currently on its way to a 40 plus pip move and most likely may target the breakout area level from Monday's longs in the US session. So reinforcing that everything is in the playbook. There is nothing confusing if you actually are in the process each day looking for the opportunities. We had first bounce trades on RBA, the Aussie dollar announcements. They were textbook perfect. But this is an example, right? Again, a market closed out of balance. No breakout of the high. We get to our timing window. It goes vertical. We have a break in structure. That break in structure is on the inside for the pump and dump. A no stress collapse back down into longs from the US window. 3 levels of rise, 3 session setup for an easy 25 plus pip collapse. Now we'll just have a quick look at gold as well. We had the false break at the high of the week. Yesterday it pulled back and took an extended amount of time before rolling over and taking out the low of the day. That triggered shorts into the market. So this is an example of a day that does not violate a previous day's low, but it closes as a breakout of the low of the day. So day one shorts possibly in the market, but also a first red day. First red day is a high of the day selling opportunity if it presents. Now gold's a bit more volatile than the other instruments, but the same criteria can be exercised. So we have a first red day opportunity, high of day, high of session. This is an example of a market where I will go to the smaller time frame, major round numbers for my entry, same criteria, but on a smaller time frame. And this market has now done a 100 pip move down. So every session, come to the screen with a thesis. The market is set up for certain opportunities if they present. Now, traders have asked, what do you do if it doesn't present? Well, I don't trade that. I'm only looking for markets that set up and behave as they should if my thesis is going to play out. So again, we have an example on gold. Lower low heading into the session. That is the setup for the pump and dump. Traders are chasing this move up and getting caught, or chasing it on a 15-minute, 5-minute, or they're going long. They're not taking any profits, or they are taking profits, or they're going to break even. Then the market reverses and they're missing the trade setup, because remember, hindsight does pay. I know that traders love saying, oh, that's in hindsight. But see, when you have a thesis coming to the screen for the session that you're trading, these opportunities are everywhere if you know exactly what you are looking for. So keep it simple, traders. I'm really going to hammer home the importance of mastering the playbook and understanding markets that have broken out when they're in breakout, or if they have broken out and failed, and the day count. The day count allows you to form a thesis, and then in the session that you're trading, whether or not there's an instrument that is low probability and to ignore it, or identify and target an instrument that is a high probability, and then knowing whether you're on the front side or the back side, and then letting that market set up. Remember the timing. Critical to understand that. So hopefully this helps. Keep it simple. The London session offers fantastic opportunities for traders. The playbook, one trade today, pays for the playbook. So keep it simple, traders. Focus on mastering those setups stick to the basic, these textbook perfect opportunities when they present. Pump and dump. There are only two types of trades: pumps and dumps, dumps and pumps. Have a great day, traders, and may the markets go with you.